Hello, you're listening to Market Matters, our market series here on JP Morgan's Making Sense podcast channel. I'm Kate Finlayson from the FICC Market Structure Liquidity Strategy team. So, as electronification continues across various asset classes, it'll be interesting to understand how this has impacted the way that market risk is hedged. In today's episode, I'm joined by my two colleagues who are very, very well placed to discuss this topic. Eddie Wen, Global Head of Digital Markets, and Nzelu, Global Head of FICC eTrading. Welcome, Eddie and Chi.
Thanks, Kate.
Great to be here.
So let's perhaps start from the basics, right? How do we, as a market maker, hedge risk? And has that evolved over time?
So if we go back, way back, we would typically manage market risk on an instrument basis. So we trade potentially into a cash product and we manage on the same cash product, or possibly cash for future and manage basis risk. And it was typically that simple. Nowadays, we tend to consider more portfolio risk. And the idea is we are market making across many instruments, contributing risk into a portfolio, distributed across clients all around the globe. So it's necessary to be able to quantify that with analytics and be very clear on the precise measure of the factors of risk that we accumulate in our portfolio. This also enables us to operate at scale as we distribute products.
Okay, interesting. Eddie, would you say that the culture of how we approach market risk has changed at all?
Yeah, I'd say so. There's definitely the movement towards from the qualitative to the quantitative. If you look at the traditional risk manager who looked at risk previously, they would qualify flows as being good or bad. The reality is there is a lot of gray in between. And with the amount of data that we have, a lot of analytics that we provide, we can now measure the quality of flows quantitatively and make decisions much more objectively. And with that, there is a culture of experimentation, right? Looking at things not just by the word of conventional wisdom, but rather does the data tell the story that we're looking for? And some of the things that we have learned over the years through the data analysis that we have has taught us a lot of how electronic trading has been a very different way of conducting business than how we've done it traditionally.
Interesting. Chi, what do you think is driving this change? What are the perceived benefits from your seat?
Sure. So we think there are a few factors that are working complementary. There is the rise of electronic trading. The more electronic trading you get, the more competition you have. Clients want to engage very similar services, multi-dealer, single dealer. Competition by providers on a single dimension, liquidity and price leads to margin compression. And as a result, you have to be very precise in your measures of risk, understanding what works for your market making strategy, properly understanding client flow. Also resource constraints, the cost of doing business, balance sheet, etc. So I would say margin compression is a consequence of competition. And as a result of margin compression, there's a lot more precision in risk management.
I see. Eddie, if we take a step back for a moment and look at the broader market structure, you and I have spoken about the development of the network-centric eTrading model with the establishment of bilateral channels of connectivity via APIs, the move away from the club model. We've seen that with FX, increasingly more with US Treasuries, and credit is an interesting space to watch too. How is the development of this network-centric e-trading model shape the ability to scale, which is what Chi was mentioning before?
Look, there's no doubt that the digital distribution process has fundamentally changed how we service our customers. The reality is that most of our liquidity is actually coming from the customers, from the network effect that we have from the servicing through the various different channels that we provide liquidity through. And increasingly, these platforms that we service are creating more of a concentration effect where we can service our customer, access liquidity from them the same way they access it from us. How we distribute our liquidity is fundamental to how we portfolio manage the risk that we've got.
I see. And Chi, how does this change in model feed into your analytics when assessing performance?
Sure. So we see the network model as a richer data set to understand. Clients can now engage with us through a variety of channels. Each one has its own attributes in terms of flow quality, transaction cost, and that enables us to customize liquidity. Ultimately, our objectives are still the same. We want to be able to distribute sustainably, scale the franchise subject to cost, and understand how protocols work. So a very good example is in the streamed model, we could distribute axes effectively across our own risk factors. In the RFQ model, that operates somewhat differently, so we can vary the services that we provide.
Okay. Interesting. So we've been talking right now about how we as a market maker hedge market risk. What about other market participants? And in terms of how our clients on the buy side might be approaching it, is it that vastly different?
I think they have similar interests and concerns. On the client side in general, they also care about transaction cost, minimizing market impact. If we consider the real money asset manager category, they typically have some risk they need to acquire, and they've gradually evolved from trading risk transfer to using more algorithmic execution so they can understand the cost of the transaction. If you move a bit further to the systematics, for example, then they look quite similar to us. They're managing risk somewhat centrally. They understand through risk models how they should manage the portfolio, and they have electronic services for distribution. And then you have the hedge funds and the banks who also try to do similar things to what we do.
I see. Okay. So, Chi, if we're talking about the movement from a single strat model to multiple pods, multi-strat, there arguably one would see the emergence of centralization of execution, perhaps from an efficiency perspective. Does that mirror how we approach it?
I think so. We've approached this similarly with a central risk model where we try to internalize products that can trade on dealer-to-dealer venues or exchanges, net down risk before we put that out on the market. This obviously reduces our footprint, saves us on transaction costs, as well as market impact. On the multi-strat model, we see very similar things happening with execution desks, and I believe that also allows them to achieve the same objectives, as well as potentially operate risk models similar to what we described using a portfolio-based approach.
Right. And Eddie, your thoughts on that?
I think there's an interesting parallel between how the buy side is forming execution desks, whereas similarly, if you look at FICC eTrading, a team that she runs, oversees eTrading across all the FICC businesses. I think the reality is as these businesses move toward electronic trading, they look more similar than different. And you're seeing that the investments you make in technology or the expertise you develop in these areas are transcending across the various different asset classes that we have. And I think those parallels are very similar in nature. A good example that I've seen with clients is that you look at one client may have combined their equities execution with the FX execution, and the traditional approach of looking at TCAs for equity algos versus FX algos are now being applied equally. So you can see those knowledge sharing and expertise sharing across the different areas. The same thing can be said in foreign exchange, where a majority of the transactions are done on streaming prices. You're seeing treasuries following the same pattern. So if you have execution desks that are familiar with that paradigm, it's very easy to take the ideas from one area and apply it to another.
And Chi, looking to more of a future state, we know we have the development of artificial intelligence continuing at pace, large language models as well. Do you think this development has any impact on how market risk is hedged at all?
So I would say in the large language model category, possibly unlikely for portfolio risk management. However, we already see interest in ML techniques in trying to understand the important features as you continue to expand the assets under a particular portfolio. We think those would typically be done offline to identify what's interesting to hedge or the best way to manage risk in a portfolio. And maybe in a future state, and I'll say long-term future, that might evolve into something more active.
Interesting. Okay. Fascinating. Well, listen, thank you both, Eddie and Chi, for your thoughts today. There are some really, really dynamic developments in this area. So something for us to keep an eye out for sure. And thank you to our listeners. Stay tuned for more FICC market structure content on this channel.
Thanks for listening to Market Matters. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, and YouTube. The views expressed in this podcast may not necessarily reflect the views of JP Morgan Chase & Co. and its affiliates, together JP Morgan, and do not constitute research or recommendation advice or an offer or a solicitation to buy or sell any security or financial instrument. They are not issued by JP Morgan's research department, but are a solicitation under CFTC Rule 1.71. Reference products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. JP Morgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. The FICC market structure publications, or to one, newsletters, mentioned in this podcast are available for JP Morgan clients. Please contact your JP Morgan sales representative should you wish to receive these. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com/disclosures. Copyright 2024, JPMorgan Chase & Company, all rights reserved.